absolutely. 2019 was an impressive year for performance, especially large cap growth stocks led the way in the 30 to 35% range, depending on the index. The S&P was up quite a bit. Small stocks were also up, but it wasn't limited to that. Convertible bonds had a very impressive return, as did high yield, all of them in the double-digit category. So in 2019, investors were surprised by that growth, especially because earnings were not robust necessarily in 2019, but there were many after the difficult fourth quarter of 18 and expectations of a continued Fed intervention, meaning that they would be hiking throughout 2019, when that was actually reversed and it became accommodative from a federal monetary standpoint and earnings weren't as bad as feared. The markets rebounded significantly. So now what we are going to enjoy is a period in 2020 where earnings are actually realized. If you look at the progression from Q1, Q2, Q3, Q4, 2020, earnings are supposed to get sequentially better each quarter. As a matter of fact, in the third quarter, comps, meaning comparisons year over year to 2019, are going to be very easy. So we are looking at a very strong earnings growth, and most bottom-up forecasts are in the 10% earnings growth range for 2020. That is going to be a successful environment for not just stocks, but all risk assets like high yield and converts as well. For 2020, rates are decidedly flat. When we were entering 2019, we had an experience where many thought rates would be rising throughout the year. Most forecasts had the 10-year Treasury above 3% as of year-end 2019. The Fed became accommodative and things became much easier, and they've eased several times now. As we look into 2020, clearly data dependency is what the Fed has communicated. From an earnings standpoint and where the economic trends look, both consumer and otherwise, it looks like the economy should be doing fairly well. Therefore, the Fed can remain mostly on the sidelines. So we don't anticipate a significant amount of movement there. What that does mean for high-grade corporates, investment-grade corporates, is that you won't have the same tailwind of falling rates that you did have in 2019. It won't be negative, but it isn't something that would be a wind at your back. So when we look at high yield and its above coupon performance in 2019, that was due to credit quality improvement and spreads narrowing, but it was also due to rates falling. We don't expect rates to fall much in 2020, therefore returns would be more like coupon rather than additional interest rate vol additives in that performance. U.S. equities are making new highs. There's no question about it. They're not making necessarily new valuation highs, although valuations are extended, but it doesn't mean that they're making new highs. We've seen several periods in the past where valuations have become much more extended than they are today. Earnings is the primary driver of stock performance. Earnings trends are clearly better in 2020 than they were in 2019. So the PE, or that valuation metric, should condense as earnings continue to improve. If companies are able to exceed or meet expectations even for what we have, the PE should be coming down or at least stay flat in 2020. So the opportunities are vast, whether it be in healthcare, where there's M&A activity, as well as new growth opportunities within certain industries within healthcare. We see opportunities, of course, in technology, both in chips and those supporting 5G growth. The amount of streaming services that are available today take extreme bandwidth, so there's going to be a lot of innovation around that because that's what the consumer wants to spend money on. So there's going to be a lot of opportunities there, and that's exciting. As far as industrials and maybe energy, which had a big move of late, those are a little bit more wait and see. We need to make sure that the fundamentals support that growth. So all those might be opportunities in 2020. Well, what's important to know about income and growth is that it was designed to be an evergreen product. We don't believe that investors should choose year to year on a product standpoint like income and growth. Income and growth is designed to have a relatively stable, high payout relative to opportunity sets within fixed income only. What the investor expects with that extra payout is volatility, meaning that if stock prices go lower, the NAV is going to be impacted because the convertibles and clearly the equity sleeve of income and growth are going to have a negative performance if stock should decline. High yield would also move directionally in the same way, but have much more of downside protection based on their structure as a bond. Convertibles, of course, have downside protection, but not nearly as much as a straight bond would. So when we think about what are the opportunities specific for 20, earnings growth trends are so positive at this point, it would take a significant disruption outside of the normal economic path that would throw us off where we are expecting positive 10% growth for earnings in 2020. Therefore, equities should do fairly well. Converts would follow, and high yield should also be in the positive range. So when we look forward, will it have the type of return that it had in 2019? That's unlikely because there was a big reversal. There was an overwhelmingly negative sentiment at the beginning of the year coming out of the fourth quarter of 18. So when we look into 20, expectations are certainly stronger, and therefore some subtle volatility might be there in and out different months. We certainly have an election cycle we need to be aware of. Who the leading candidates are as we get into the second half of 20 is going to have a big impact day to day on the market. But right now, fiscal policy is clearly constructive. It doesn't mean that it's perfect, but it is constructive. There are no inhibiting fiscal policies that are there, whether it be new additional taxes or regulatory oversight that are going to be a dampener on earnings growth or economic ability for companies to grow and prosper. So we are constructive certainly as we go into 2020. Yes, short duration high income is not necessarily driven by interest rates. As a matter of fact, it's proven to be somewhat interest rate agnostic or insensitive to interest rate volatility. The Fed being accommodative should be looked at more from an economic standpoint. So if the Fed continues to be positive as an influence, meaning that they are accommodative for company growth, for earnings acceleration, that would be positive for the credits in the short duration high income product. So if the Fed was also equally to change direction, the economy grows much faster than expected and the Fed starts hiking, actually the short duration aspect of short duration high income would be a positive for clients that are exposed to other longer duration assets that might have more negative impact of rising interest rates. So we need to think about short duration high income as not having overly sensitive nature as respect to either the Fed or especially long-term treasuries moving up or down over time. It's about the team getting the credit quality selection correct and choosing those companies that are going to meet or exceed expectations going forward, far more than it is what is the Fed's next meeting going to be.
Allianz Global Investors.